It looks like some of the biggest names in tech are quietly taking their next steps into the world of crypto. And they're not starting with hype. They're starting with our stablecoins. According to a new report, companies like Apple, Airbnb, and Google Cloud are actively exploring how to integrate stablecoins and blockchain technology into their existing platforms. While none of these tech giants have made splashy public announcements, behind the scenes, real conversations are happening, and the implications could be massive. At the center of this quiet shift is the idea of frictionless payments. Companies like Airbnb have long wanted to make cross-border transactions faster and cheaper. Stablecoins, especially those pegged to the US dollar, offer a way to do that without relying on outdated banking systems. They can settle in seconds, operate 24/7, and drastically reduce fees, something both businesses and users would benefit from. Apple, meanwhile, is reportedly engaging with industry leaders to explore how stablecoins could fit into its payments ecosystem. With Apple Pay already dominating the mobile wallet space, even a subtle move toward crypto compatibility could have ripple effects across the entire financial sector. Then there's Google Cloud, which has taken a more visible step by partnering with Web3 and blockchain projects in recent years. From hosting nodes to providing developer tools for decentralized apps, Google is positioning itself as the cloud backbone for crypto, and stablecoins could be the next logical piece. So what's holding them back? Regulation, as always, is the biggest factor. While the technology is ready, many companies are waiting for more clarity from US lawmakers before launching stablecoin features at scale. The recent uptick in bipartisan interest around crypto legislation suggests that change may be coming, and fast. There's also the reputational risk. Companies like Apple and Airbnb are consumer-facing brands. They move cautiously, especially when it comes to emerging tech that's still viewed as volatile or controversial. But their growing interest signals that crypto is maturing, and that stablecoins might be the bridge between today's platforms and tomorrow's financial systems. What's particularly notable is that none of these companies are trying to reinvent the wheel. They're not building new blockchains or launching their own tokens. Instead, they're re-exploring existing stablecoin infrastructure, like USDC, and asking how it can quietly make their platforms faster, cheaper, and more efficient. If these quiet conversations become real integrations, it could change everything. Payments, loyalty programs, subscriptions, and even peer-to-peer transfers could see a massive shift, not just in how they work, but in who controls them. One thing's for sure, the crypto space is no longer just startups and exchanges. Now, the giants are moving, and they're doing it strategically. Stay tuned as we watch what could be the next big wave of crypto adoption, led not by hype, but by some of the most powerful tech companies on Earth. This year's Bitcoin 2025 conference in Nashville was supposed to be about technology, innovation, and the future of decentralized finance. But what unfolded was something much more complex. A collision of two very different worlds, crypto purists and the MAGA political base. Once celebrated as a niche gathering for libertarian-minded developers and Bitcoin maximalists, the Bitcoin conference has grown into a massive cultural spectacle. Thousands of attendees poured in, including crypto entrepreneurs, tech-savvy investors, and, more recently, a wave of conservative political figures and influencers. The shift has raised eyebrows among longtime Bitcoin advocates. For many early adopters, Bitcoin was meant to be politically neutral, a decentralized tool for individual freedom and financial independence, not a platform for partisan agendas. But this year, the tone felt different. Several high-profile speakers tied Bitcoin's future to right-wing narratives, drawing applause from MAGA-aligned attendees and sparking discomfort among others in the room. prominent conservative voices used the stage to criticize central banks, attack regulatory agencies, and even frame Bitcoin as a hedge against government overreach. For Bitcoin believers on both sides of the political spectrum, it was a strange mix. Tech optimism wrapped in political tribalism. Panels that once focused on protocol upgrades and privacy tools were often overshadowed by culture war rhetoric and campaign-style messaging. This ideological tension highlights a deeper identity struggle in the crypto space. Is Bitcoin a neutral technology that belongs to no one? Or is it becoming a political symbol? The answer may shape how it's adopted globally. Some developers and purists are now concerned that turning Bitcoin into a partisan talking point could backfire, alienating regulators and limiting broader adoption. Others argue that Bitcoin's message of sovereignty and limited government naturally appeals to politically conservative communities, especially in the US. Outside the main stage, the event still had plenty of technical discussions, business networking, and passionate grassroots energy. But the cultural clash was hard to ignore, and it has left many in the community questioning what the future of Bitcoin gatherings will look like. Bitcoin 2025 revealed more than just market sentiment. It exposed a growing divide in how people view the purpose of crypto itself. Is it about freedom from all control, or is it being pulled into new forms of influence? As Bitcoin continues to grow in relevance and visibility, the lines between finance, tech, and politics are becoming harder to separate. One thing is certain: the crypto revolution is no longer just about code and coins. It's also about who gets to define what Bitcoin stands for and where the movement goes next. Stay tuned. In the fast-paced world of crypto, reacting quickly to breaking news can make or break a trade. Now traders are exploring how artificial intelligence, specifically ChatGPT, can be used to turn crypto headlines into real-time trading signals. According to a recent report, crypto investors are starting to experiment with AI tools to gain an edge, using platforms like ChatGPT to analyze news stories, extract sentiment, and generate potential trading insights faster than a human ever could. So how does it work? It starts with feeding ChatGPT recent crypto news, from regulatory announcements to market movements, exchange listings, or project updates. The model then evaluates the tone of the news, identifies which assets are affected, and can provide a basic outlook, whether the event is likely bullish, bearish, or neutral for the token involved. While this isn't the same as financial advice or a guaranteed trade setup, it's a powerful tool for screening information. Instead of manually reading dozens of headlines, traders can get AI-generated summaries and sentiment analysis within seconds, helping them act faster in volatile markets. Some traders go even further, building custom prompts or automations that feed live news directly into AI models. For example, if ChatGPT detects a story about increased Bitcoin adoption, it might flag a possible long setup. On the other hand, negative headlines about lawsuits or exchange hacks might trigger a caution signal or suggest short setups. The potential applications are wide-ranging. Traders can use AI for filtering noise from real signals, tracking sentiment across tokens and sectors, monitoring market reactions to headlines over time, even generating watch lists based on trending narratives. However, it's not without risks. AI tools like ChatGPT don't have real-time market data or emotional intelligence. They're only as good as the information you give them, and they can misinterpret sarcasm, context, or subtle shifts in policy language. Relying solely on AI for trade decisions is not recommended. Still, for those looking to speed up their research or add another layer to their strategy, AI is becoming a valuable assistant. As the technology evolves, we are likely to see more traders, both retail and institutional, integrating AI into their toolkits. The bottom line? AI won't replace traders, but it can help them move faster, think smarter, and stay ahead of the curve. Whether you're day trading, swing trading, or just tracking the market, combining human intuition with AI-powered insight could be the next evolution in crypto strategy. Stay tuned, because in this market, the next big opportunity might just come from a headline. Australia has just rolled out a new restriction that's sending ripples through its crypto community. The government has announced a cap on transactions at crypto ATMs, limiting users to 5,000 Australian dollars per transaction, a move that could significantly affect how Australians interact with digital assets. The new rule is part of broader financial reforms aimed at tightening anti-money laundering and counter-terrorism financing controls. Authorities say the cap will help prevent illicit use of crypto while still allowing legitimate access. But not everyone is convinced this is the right approach. Crypto ATMs have grown in popularity across Australia in recent years, especially among users who prefer physical access points over centralized exchanges. They've provided a relatively easy way for people to convert cash into crypto and vice versa. Now, with the new AU $5,000 cap, users may find themselves restricted in how much they can transact at once or forced to split larger transactions across multiple sessions. The change has sparked mixed reactions. Supporters of the policy argue that it's a necessary step to align with global financial standards and to keep crypto from being exploited by criminals. But critics say it's just another sign of governments overreaching into a space that was designed to be decentralized and permissionless. Some industry voices have warned that this could set a precedent for other countries looking to curb crypto activity through regulation rather than innovation. Others worry it may drive users away from ATMs altogether and into more private or unregulated peer-to-peer markets, which could defeat the purpose of the restriction. At this stage, the AU 5,000 limit applies only to single transactions, not cumulative daily totals, but financial regulators haven't ruled out additional rules in the future. It's also unclear how this will impact ATM operators, some of whom may struggle to stay profitable if large volume transactions are reduced. The Australian crypto scene has been growing steadily, with increasing retail interest and a number of blockchain startups emerging from Sydney, Melbourne, and Brisbane. But this move adds a layer of uncertainty, and it's not yet clear how the market will respond long-term. For now, one thing is certain. As governments worldwide grapple with how to regulate crypto, limits like these may become more common, and users should be paying attention. We'll continue to monitor how Australia's ATM cap affects the market and whether other countries decide to follow suit. Stay tuned for more updates as the regulatory landscape continues to shift. In a major move that could reshape the crypto exchange landscape, Gemini, the crypto company founded by Cameron and Tyler Winklevoss, has confidentially filed for an initial public offering, IPO. The filing signals that Gemini may soon become one of the few major US-based crypto firms to go public, joining the likes of Coinbase. While details are still under wraps, including the offering size, timeline, and valuation, the move marks a bold step forward in what's been a challenging environment for crypto companies. Gemini has long positioned itself as a compliant and regulation-friendly exchange, distinguishing itself from many of its global competitors. The company has worked closely with US regulators and banking partners, emphasizing trust and transparency as key pillars of its brand. Now, with a potential IPO in sight, those efforts appear to be part of a larger strategy to build public investor confidence. Founded in 2014, Gemini has offered a range of services, from cryptocurrency trading to custody, staking, and stablecoin issuance. The platform has also been active in the NFT and Web3 space, and even launched a crypto rewards credit card in partnership with MasterCard. Despite these innovations, Gemini has faced its share of challenges. The company was caught in the crosshairs of last year's crypto credit crisis due to its ties with Genesis, the now bankrupt lender. The resulting legal battle with the SEC over its EARN program cast a shadow over Gemini's operations, raising questions about its future. But this IPO move suggests the company is aiming to turn the page and potentially secure fresh capital to expand in a market that's showing renewed strength. Going public could help Gemini boost its brand, build new partnerships, and compete with larger players like Coinbase and Kraken. It would also offer retail and institutional investors a new way to gain exposure to crypto infrastructure without directly holding digital assets. However, the timing is critical. The broader IPO market has only recently started to thaw, and regulatory uncertainty still looms large over the crypto industry. A successful Gemini IPO could signal returning confidence in US-based crypto firms. But any missteps might be closely scrutinized by both investors and regulators. For the Winklevoss twins, who famously clashed with Mark Zuckerberg over Facebook's origins and later rebranded themselves as Bitcoin billionaires, this IPO represents yet another evolution in their tech journey. From rowing in the Olympics to riding the crypto wave, Cameron and Tyler are once again aiming to make history, this time on Wall Street. We'll continue to follow this developing story and bring you the latest as Gemini moves closer to becoming a publicly traded crypto exchange. Stay tuned. The world of crypto is often seen as complex, technical, and intimidating, but Pi Network is on a mission to change that. Their goal? To make using cryptocurrency as easy and natural as spending cash. And with over 60 million users already on board, they may be on to something big. Launched by a group of Stanford graduates, Pi Network started with a simple mobile app that allowed people to mine tokens on their phones without draining battery or requiring high-end hardware. At first, many dismissed it as just another gimmicky crypto app. But over the years, the project has quietly grown into a global movement. What sets Pi Network apart is its focus on accessibility and real-world usability. Rather than building for high-frequency traders or institutional investors, Pi is aimed at everyday people, those who've been left out of the crypto revolution due to technical hurdles or economic barriers. Now, with tens of millions of users in over 230 countries, Pi is preparing to launch its open mainnet, a key milestone that will allow real transactions, app development, and integration with the broader blockchain ecosystem. But here's what really matters. Pi wants to become a currency people actually use, not just trade. The project is building a network of apps, services, and merchants who accept Pi for goods and services. That means users won't need to convert their crypto back to fiat. They'll be able to spend it directly in a growing ecosystem, much like cash. And while it hasn't hit major exchanges yet, Pi's internal ecosystem is already buzzing. A peer-to-peer marketplace, developer tools, and business onboarding are all in the works, setting the stage for a practical, community-driven crypto economy. Still, challenges remain. Critics question the project's transparency, centralization, and long development timeline. The token hasn't launched on major markets, and its current value is mostly speculative. But Pi's creators argue they're retaking a measured approach, prioritizing infrastructure and security before chasing hype. If Pi Network delivers on its promise, it could flip the script on what crypto adoption looks like. Instead of leading with profits or price charts, it is leading with usability and community. Two things the crypto world often overlooks. With the open mainnet on the horizon and momentum still building, Pi Network is one to watch closely. Whether it becomes a true global cryptocurrency or just another niche experiment will depend on how it handles this next phase. Either way, 60 million users and counting suggest that something interesting is happening here, and it's just getting started. Revolut, the global fintech giant known for its sleek app and all-in-one financial services, is making another bold move into the world of crypto. The company has officially announced plans to launch crypto derivatives trading on its platform, a step that marks a major expansion of its digital asset offerings. The new feature will allow Revolut's users to trade crypto futures and other derivatives, instruments typically used by professional traders to hedge risk or speculate on market moves. Initially, the service will be rolled out to select users in the UK and certain European markets, with a broader release expected later this year. This launch positions Revolut as one of the first major consumer-focused fintech apps in Europe to offer crypto derivatives directly to retail users. Until now, this kind of trading has mostly been confined to specialist platforms like Binance, Bybit, or OKX. Revolut's goal is to make these tools more accessible, user-friendly, and integrated into a wider financial ecosystem. Crypto derivatives are complex products. They allow users to bet on the price movement of assets like Bitcoin or Ethereum without owning them outright. They can be powerful tools, but also come with high risk, especially when leverage is involved. Revolut says it's designing its interface with built-in risk warnings, educational tools, and limits to help users trade more responsibly. The move reflects a broader trend in fintech, combining traditional finance tools with crypto functionality, all within a single app. Revolut already lets users buy and sell over 100 cryptocurrencies, and it offers staking, wallets, and even educational modules. With derivatives now being added, the app is inching closer to becoming a full-service crypto exchange. Regulators are watching closely. Crypto derivatives are heavily scrutinized in many countries due to their risk profile. Revolut has assured it's launching the service in compliance with local laws and under the appropriate licenses. From a business perspective, derivatives could be a major revenue stream. Platforms offering futures and margin trading often generate far more trading volume than spot-only services. This could help Revolut boost profits from its crypto division while offering more options to advanced users. Still, the rollout isn't without challenges. Many users are unfamiliar with derivatives and may not fully understand the risks. Revolut's success here will depend on how well it can balance accessibility with safety. As Revolut continues its evolution from a banking app into a global financial super app, its crypto ambitions are clearly growing. This move into derivatives shows it's not just interested in letting users buy coins, it wants to be a serious player in the future of digital finance. We'll be keeping an eye on how this expansion unfolds and what it means for the wider crypto landscape. XRP is once again at the center of market speculation, and the big question being asked right now is, could XRP retrace back to 220, or is the recent momentum here to stay? After a strong run earlier this year, XRP has seen its price consolidate below key resistance levels. At the time of reporting, XRP is hovering around the 240 mark, still well above 2024 averages, but losing some steam as broader market volatility picks up. Analysts are now debating whether a pullback to the 220 support level is likely in the short term. Technically, that zone has served as a previous base during XRP's last rally, and a revisit could create a foundation for a new leg upward, or signal weakness if broken. But while price action is under scrutiny, the Ripple Foundation has been quietly making strategic moves that may support long-term value. According to new reports, Ripple is deepening its ties with global financial institutions, expanding cross-border payment corridors, and pushing the integration of XRP ledger-based solutions into real-world use cases. One major development includes Ripple AS ongoing pilot programs with several central banks testing CBDCs, central bank digital currencies, that may run on or connect with Ripple AS technology. There is also growing interest in tokenized real-world assets, like real estate and commodities being built on the XRP ledger, adding to the token's utility narrative. Ripple's goal has always been clear: to make XRP the go-to bridge asset for institutional finance. And that mission continues to advance, even if slowly. However, despite these advancements, XRP's price remains sensitive to broader market trends. With Bitcoin and Ethereum experiencing significant volatility, altcoins like XRP tend to follow suit, especially when traders are heavily leveraged. Some technical analysts suggest that if XRP breaks below 230, a dip to 220 is not only possible, but probable. On the flip side, if bullish momentum returns and XRP can reclaim $2.50 with strong volume, the next target could be as high as 2.80 or beyond. In short, XRP sits at a crossroads, with strong fundamentals pushing one direction and market noise pulling in another. Whether we see a retest of 2.20 or a renewed breakout in the coming days will likely depend on both macro sentiment and how Ripple continues executing its long-term roadmap. We'll keep tracking every move as it unfolds and bring you the latest on XRP's price action, adoption, and future in global finance. Stay tuned.